Is brought to you by the Moab Chamber. Cora Phillips is here with us today. You are also seeing Karen Wilson, who is with the SBC team. She is going to be monitoring the question and answer. So if any of you have a question as we go along, please drop that in the question and answer. Once Karen or myself is able to answer it, if I see it, I will try to answer it as I'm speaking. And then you'll be able to see the answers to those questions once Karen or I respond to them as well. So that way everyone can see that answer. Cora, I don't know if you want to say anything in particular. If you do, right now would be a great time. So go ahead and let everybody know hello.
Yes, we're so excited to partner with Christy and Karen from Small Business Consulting. Christy reached out to me after probably popped her an email. Super excited about this partnership. They have lots of other training opportunities available, and we're so excited to um, have this virtual offering to make it more accessible to our chamber members. We are renewing memberships on May 1st, so this Friday, if you've kind of considered joining and wondering what you can get out of the chamber, this is just one of those mini examples, and we would love to have you as one of our chamber members so we can work together to grow our economy.
Thanks, Cora. So you guys are all here today to learn about tracking your business financials, and this is brought to you by the USBCI program, which is currently administered by the Utah Governor's Office of Economic Opportunity. There are 4 different webinars throughout the year as part of the USBCI program. This is the second that we are having here for Utah. There will be our next one will be on credit counseling, and the fourth one is yet to be scheduled. So keep an eye out for those as well. Since you are part of our Eventbrite family now, you will see notifications as far as when those webinars are posted. Credit counseling, I believe Karen is already out there, and you can go ahead and register for that one. Okay, perfect. So we're going to go ahead and get started because we're only an hour long and we're 6 minutes in with all the chaos that we were having. This is an SBC workshop, as we mentioned, SBC Small Business Consulting. My name is Christy Dudgeon. I am the president of SBC Consulting. Feel free to follow me or link with me on LinkedIn. Our website is here as well as SBC Consulting's LinkedIn. And this is our consulting team. So we are providing technical assistance throughout the state of Utah as part of the USBCI program. So if you found this workshop based on our Facebook ad that we were running in the last week, and we asked you the question, do you want to be contacted by SBC for one-on-one consulting? You have already been registered into the USBCI program, and our team will be reaching out to you. If you are coming to us directly from the Moab Chamber, this was not one of those items that we released to you yet. However, we will be showing you how you can register as part of the program if you want further assistance one-on-one from one of our consultants on our team. It is provided to you at no cost as part of that USBCI program. So what does tracking your business financials actually mean? It means that you know your numbers, your finances are organized and up to date, you can manage your cash with intention, and you can confidently explain your business financially. Now that seems like a tall order, especially if your business is just starting out, but hopefully we're going to give you some tips and tricks about how you can do that maybe a little easier and not make it such an overwhelming thing. This really is not about perfection. It's about clarity and consistency. And obviously, the more that you do it, the more that you will become more skilled in what it means to actually maintain your finances, track those finances, and then be more prepared when someone might ask you for specific documents that we're going to talk about today. If you were asked to send me your P&L or your balance sheet right now, which one of these would you say? Feel free to go ahead and add it in the open questions just so we know. Karen won't necessarily respond to it, but it kind of gives me an idea of where everybody is at. So you might say, I've got those. How do I send them, right? That means you are tracking well and you're pretty confident in those numbers that you're going to receive for your financial reports. You don't have them, but they are, or you do have them, but they aren't correct. We hear this quite often, right? So we've got some tracking in place, but we're not really sure or confident in the numbers that we're now seeing on those reports. Can I get back to you in a week, a month, or a year? This is often I've got to put those together for you. Or what are those? Do we even know what I'm talking about when I say the profit and loss, the P&L, or the balance sheet? You may not know those right this moment, but you're going to know those here in just a few minutes. So, number one, we want to create a consistent financial management system. And what I mean by that is you want something that you are using. So whether it be a piece of paper, a spreadsheet, or software, obviously when we get into software, it's more automated and we're able to understand and use those tools a little bit better. It's going to be help us from a time management standpoint, but however, those do often cost money, right? And so maybe we start out with a spreadsheet. That's a normal starting point. Whatever we're utilizing, though, the important message here is use it and use it consistently, right? So when you do that, you stop guessing and you really start knowing what you're doing. You can make decisions with confidence. You avoid surprises. This is a great one, especially with cash and maybe taxes. We just now crossed over, tax time from a federal standpoint. You can clearly see what's working within your business and what's not, and you become prepared for opportunities and also those challenges that come up every day within our business. So, the basics of a strong financial management system are really these four things that you're going to see over here on the left-hand side. And they also coincide with what's on the right-hand side here. We want to be organized. We want to then track. We then need to verify, and then we can understand. Those are kind of the four steps here. So, how we can organize is it's called a chart of accounts, and this is a list of these different accounts, or buckets is another word to think of, that we take every transaction that happens within our business and then we put it into one of these buckets. So, in order to do that well, we need to have it very simple and very clear. The transactions then get categorized. You may hear it as classified also. These are different terms out there in the world. But basically, that just means we take each transaction, money coming in, money going out, whatever it may be, and we put it then in one of those buckets. So we choose a category of one of those chart of accounts to put it in. And then we need to reconcile our accounts monthly. And reconcile means we're basically balancing the numbers. Did the number happen? Did we record it correctly? And then we know that all of our values are correct. And don't worry, we're going to go into these a little deeper as we go through this. And then we know that we can have accurate, up-to-date reports once we have that clear, clean chart of accounts. We are then categorizing all of our transactions, and then we reconcile to make sure all of those values are accurate. So, as I mentioned before, from a financial management and tracking standpoint, there are many tools that are out there that are available. Either that piece of paper, spreadsheet, QuickBooks is very common as part of the USBCI program. We can help you set up and learn QuickBooks. So that is there. Different companies such as SBC, the Women's Business Center, the Small Business Development Center, all of these great programs out there offering this free assistance can help you get these set up. So step one in tracking, as I mentioned, we were going to go a little bit deeper, is the chart of accounts. So this is a list of all the financial categories used to organize your business transactions. That's kind of the real definition of a chart of accounts. This structure tells your bookkeeping system where the money is going, and it really is the foundation of all the financial reports that you may need. Every dollar that comes in and goes out has to touch one of these accounts. So it's really important that we have them correct. There are 5 main account types that you need to be aware of in order to start tracking your business finances. Once you know those 5 main types of accounts, every other account is part of one of those 5. So understanding that 5 is a big deal. And we're going to go through all 5 of those right now. So the first one is assets. These are things that the business owns and they have a value. So common asset examples are business bank accounts, cash on hand, accounts receivable. This is when we invoice someone and we're waiting for that money to come in. It's called accounts receivable. Equipment and tools, vehicles owned by the business, inventory, property owned by the business. So these are all things that we can pretty much see, touch, feel, right? These are what we own and they have a value. The next of the main five that we need to know is called liabilities. These are things that the business owes and they have a value. So liabilities are the business's debts. Common liability examples are business loans, lines of credit, credit card balances, accounts payable, bills that haven't been paid yet, payroll taxes owed, sales tax collected, equipment and vehicle loans. These all fall under that world of liabilities. So if your business has to pay it back, basically, it's called a liability. The third of the five you need to know is equity. This is the owner's stake in the business. So this is the value of the business to the owner. This is also where many small business owners, being sole proprietors, partnerships, or LLCs, will pay themselves. So this is how we invest money into our business. This is also the money that we can take out as a small business owner. So equity is not an expense. We sometimes think ourselves as a business owner, we're an expense. We might be expensive, but we're not an expense. And equity is also not income. So when we invest our own money into our business, we don't want to call that income because we certainly don't want to pay taxes on that money that we've invested. It's how the owner's relationship with the business is also tracked. So if we are to the point where we want to sell our business, so we've got this exit plan going, this is how valuation for the business is determined. So there's often a formula. You might have heard of a thing called EBITDA or EBITDA. That is where equity comes into play and kind of how the owner is tracking their own expenses. So it is really important that we do understand equity and that we start to use it correctly because this keeps our business finances accurate. Remember, we want to make sure that we're not calling things expenses and not calling things income when they're not. It's also how we separate our business activity from our personal activity. As business owners, it's often very difficult for us to separate ourselves from our business because we generally are so intertwined, as well as a lot of times our personal money in the very beginning. But we do need to keep all of that activity separate, and equity is one of those places that we're able to do that correctly. It also helps us understand how much, as an owner, we have invested as well as withdrawn from the company. And it really does maintain those clean financial reports because we are putting things in the correct area. So, best practice from a setup standpoint when we are keeping our business finances separate from our personal finances. Definitely open a business bank account, right? So, first step in keeping things separate is to have a separate personal account from a separate business account. Also, using a business debit or business credit card as opposed to a personal card. Now, sometimes it's difficult when we're first starting out in business in order to qualify for a business card. So, the recommendation often is take a personal card and only use it for business purposes, right? Because then we're not intermingling or commingling is actually the word of those funds between business and personal. So keep personal spending out of your business accounts if at all possible. Sometimes there are mistakes that happen, and that's okay. That can be fixed. And you also want to pay yourself intentionally, not randomly. I know this is one of the hardest things for new business owners to be able to say, I could barely pay my bills as a new business. How in the world am I going to pay myself? And that's why I say intentionally, because you're actually setting up a standard in which you're going to pay yourself. Now, that doesn't mean that you're truly going to pay yourself, right? If the money's not there from a cash flow standpoint, you may say, not this time, but at least you've got that plan in place, right? And so that's one of those first steps to being able to make sure that you're paying yourself intentionally. If mixing does happen, use the equity accounts to track the owner money in or the money out. If you're using a system like QuickBooks, there are two accounts that are often in equity. One is called owner's investment. So that's your money coming in, and owner's pay and personal. So that's the money then that's going out. So you can very clearly see if there's money coming in and money going out. And what I mean by that is if I accidentally spent my personal money to buy something for the business, right? I just happened to be there. I grabbed the wrong card or whatever it may be. I'm going to call that an owner's investment, and then I'm going to say whatever that expense was for two reasons. One, I want to make sure that that investment is credited right on my expense or on my equity, and then I want to make sure that the business expense is also showing up on my reports, because I want to be able to have the credit for that tax deduction or that expense when the time comes. And that helps me accurately understand how much money I truly have been spending on the business, as well as how much money I've been putting in the business. So flag those personal transactions. And what I mean by that is if I'm looking at my personal statement, my personal bank statement, right? I want to go through there and see if there's anything that was business related so that I can properly account for it, right? So I want to say that that's that investment going in as well as that expense coming out. And then vice versa, right? So if I accidentally utilize my business account to pay my car payment or my credit card, whatever it may be. We want to call that owner's pay in personal as part of equity. And then whatever you did with it on the personal side, the business doesn't care, right? So whether you're paying your credit card, your car payment, whether it was your actual payment to yourself, it's not important at that point, right? It's irrelevant. But what you do need to know from a business standpoint is that was money going directly to you for personal reasons. And so you're going to call that owner's pay in personal. This helps you accurately track and keeps your reports reliable. Um, it's the best setup that you can get to, right? To make sure that these financial reports that we're going to talk about are correct. So we've talked about assets, liabilities, and equity so far. The fourth one is income. So this is money in that the business receives in exchange for providing labor, producing a good or service, or through investing capital. So this could be our income, our revenue, also our sales. With expenses, there's two types of expenses. This could be direct. So this is cost of goods sold, money out, spent, or cost incurred by a business directly resulting in revenue, as well as indirect. So these are our overheads, administrative, operating expenses. Basically, indirect is really just the cost of doing business. We're going to have those expenses no matter what, even if we didn't sell anything. So this is pretty common during startup to have a lot of indirect expenses. And then we can utilize these reports as we start to talk about them in the future to really manage what often we call as overhead or administrative, right? Because we want to keep that to a certain amount as our businesses start to grow. Those direct expenses are important that we also identify those correctly from our indirect expenses because if we want to know what our gross margin is in particular, if we don't have those broken out to say that was a direct expense. So think of this like I buy a product and I resell it. So that's a direct expense. Or I buy a bunch of materials in order to create a product. That's also considered a direct expense. And we have to identify those so we can make sure that we can understand then what our margin is, right? So it's our sales less our direct expenses in order to get that margin and that percentage. And then our last one, as I just mentioned, is expense. We get to see it again. This is money your business spends to operate, costs required to earn income, payments for goods or services, or ongoing operations. So there's two types of main expenses that I mentioned, cost of goods sold, as well as operating expenses. And so this is what a very basic chart of accounts looks like if you've never seen one. And it has those five main accounts listed in the parentheses on the back end. You can make this much more complicated if you start a software such as QuickBooks. QuickBooks is going to give you a huge chart of accounts. And one of the steps that we do in our first training or implementations is help you to go through and narrow that back down by inactivating a lot of accounts. If you're already using the software, you probably have noticed that there's a ton of accounts in there you don't need, right? And if you don't need those accounts, then there's no reason for them to be in there because you just spend a lot of time scrolling through them and maybe you're accidentally using them as well. So at the most basic asset would be a checking account, right? As I mentioned before, it's your bank accounts. You might also have accounts receivable up here if you are invoicing people. The most basic from a liability standpoint would be a credit card. If you have to charge sales tax, or if you have payroll taxes, or you have a loan in particular, that's going to be in that liability group as well. And then we've got those equity accounts that I talked about. So owner's draw and owner's investment. So we can properly have that money coming in and going out. And then we have our expenses. So at the top of our expenses are going to be those direct expense accounts, also known as cost of goods sold. So we're going to see those at the top. And then what usually makes up the bulk of our chart of accounts is all of those overhead or administrative expenses. And so you can kind of see the most common ones listed here. So we've got rent, utilities, advertising and marketing, software and subscriptions, meals, business related, obviously, vehicle and travel, and then professional fees such as a bookkeeper, accountant, or legal expense. So this is a good starting point from a simple standpoint. As I mentioned, just based on the type of your business, you may have more accounts than this, right? But the goal here is to not have them be so similar to each other that even yourself, you're not really sure which bucket you should be putting it in. So that's why I like to say keep it as simple as possible. If you've ever looked at a Schedule C for your tax return, so a Schedule C is what a sole proprietor partnership or an LLC uses to file their taxes. A Schedule C is a very, very basic chart of accounts in itself. So you'll see the income line, you'll see the cost of goods sold line, and then you'll see those overhead expenses. What you won't see is what I would say is on a balance sheet or the other side. And so those are our assets and our liabilities and our equity. Which leads us into categorizing. So, categorizing, as I mentioned before, is where we're assigning each of those transactions to the correct account. So, this is telling our bookkeeping system what that transaction was for. So, I see a transaction happen. I know that's my rent. I categorize it to rent. Right? Seems simple enough. And that's why we want to keep it so that they're not so similar to each other that we're not really sure where it's supposed to belong. We are ensuring that our money coming in and our money going out is recorded accurately. So categorizing is putting each of those transactions in the right place, and every transaction has to have a category. That's how we build our reports. Then we have to reconcile. And so, what does reconciling mean? It means that we're double checking our numbers. If you've ever balanced a checkbook before, this is a pretty much the exact same process, but we're not just doing it for a checking account. We're also doing it for credit cards. We can do it for loans as well. So we're making sure that every single transaction that we have recorded in our system is also showing up on those bank statements, right? And we're catching any errors because errors always happen. And we want to make sure that there's nothing that's duplicated. We also want to make sure that there's nothing missing. Otherwise, our reports are not accurate. And so we can find those missing or duplicate transactions, and we can also identify bank or card errors. Reconciling ensures that the values of our accounts are accurate. So, what does reviewing reports mean then in this fourth step? We're looking at our financial reports regularly. The most accurate moment that you're going to see of a financial report is once you've categorized everything and you've reconciled your accounts. Typically, we're doing that somewhere in the month following the prior month, right? Because we've got to wait until we've got those bank statements in order to be able to double check all of those things. You may even be tracking your financials at the moment that you receive your bank statement. You might not be doing that work ahead of time. Remember how I said, however you do it consistently, right? And so if that's your plan, then go with that. So you are still at that point, though, taking everything, putting it in the correct buckets, and you're making sure that there's no missing or duplicated transaction. Once you're also confirming that all of your hard work is correct, right? So if you've been categorizing throughout the month, you're looking at these financial reports to be able to say, okay, I put these things in the right bucket, because usually we'll see it and then we don't see it again until we look at our reports. But that's also why looking at our reports is extremely important, because we want to confirm that things are correct. And it's hilarious, actually, the number of business owners that we work with that have never seen their financial reports before. And the first time that they look at them, they're like, oh, what is that? I didn't spend money on that, right? Or they didn't remember spending money on that. And so you can click in, if you're using a software like QuickBooks, you can click into it and you could actually see all of the transactions under that. If you're using something like a spreadsheet, you're going to have that right in front of your face too, as well, as long as you're putting each individual transaction on that spreadsheet. That's a lot of manual entry probably, but it gives you the visibility to know what's in every single one of those buckets. And then you're going to use the information then that comes out of those reports to ultimately guide your future business decisions. So they tell you what's happening in your business and they provide the data that you need to make those decisions. So, what are those financial reports that I keep talking about? I've mentioned two of them. So the profit and loss and the balance sheet. So at the very beginning, I asked you, if I asked today if you could provide me with those profit and loss reports, what would you say, right? And so the profit and loss is telling us if we're making money. This is from a business owner standpoint, right? Why do I care about this report? I want to know if I'm making money. The balance sheet tells me what do I own and what do I owe, as well as what my equity is. And then cash flow, this is going to say, do I have money? Now, there's some tricks to the cash flow report in order to be able to generate it, but we're going to talk about that here in a minute as well. So those three main financial reports are listed here in my little doodle on the napkin, that balance sheet, the income, and the cash flow. These are also three reports that if you're interested in capital or funding, often if there's a grant situation even that you're looking for, these are probably going to be three reports that you're going to get asked for as well. So having our financials tracked in that simple system that I was talking about, have your chart of accounts, then you're going to categorize everything, and then you're going to reconcile those accounts. You're then going to have these financial reports that you can provide and make decisions off of. So let's talk about the profit and loss report, also known as the income statement or the P&L. You may see all of those interchangeably. It is the exact same report. The reason it's called the income statement is because it's what lists our income. The reason it's also called a profit and loss report, it is the report at the very bottom, also known as the bottom line, that tells us if we are making a profit or if we have a loss, right? So a positive number down there means we're profitable. Negative number down there means we have a loss. It's showing us how much money our business made, how much we spent, and whether we have a profit or loss, right? It matters because we can see if we're profitable. It helps us see where our money is going, especially if we are using those direct expenses versus indirect expenses. We can help determine what those margins look like, right? And it's often required for loans or funding. Not often, it generally is almost all the time. Um, we are looking at this, if you've not looked at it before, a couple key things. Does the income look accurate? So I know that most business owners, even if they've never seen their financial reports before, they usually know exactly how much money or close to how much money they're making, right? We track that pretty close, especially when the business is starting up. Also, do our major expenses make sense? So as I mentioned before, someone will look at their expense categories and be like, whoa, 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 we didn't spend that much money on advertising. What is that about? It could be something that's miscategorized, or really in the end, we did spend that much on advertising. That softwares and subscription one is that gets a lot of people because we don't realize how many subscriptions we've actually signed up for and that we're paying for on a monthly basis. But obviously, tracking our financials will help us understand exactly how much we are spending. You also want to be able to just look at it real quick and say, is anything unusual or missing, right? So we do that first glance over it and we're reviewing, is this accurate? Is this accurate? Then we could start to dig into it a little deeper when we start to make decisions. But the simple takeaway, profit and loss, am I making money? It's what we want to know. Then we have the balance sheet. So the balance sheet is called the balance sheet because it's always in balance. So you'll often see a little scale. There is an equation with it, and you can see this equation in this doodle right here. So this is assets equal liabilities plus equity. That's the equation. As I mentioned before, it's always in balance. And you will notice it is three of the five that we talked about. So assets, liabilities, and equity. This report is probably the one that is the most inaccurate of all reports that we look at, especially if you're starting out with this the first time. You might have a pretty good handle on your profit and loss, but you might be a little more confused about, is something an asset? Should I have it on there? What do my liabilities really look like? And then sometimes equity is like, I didn't even know what equity was in the first place, right? And so there's a lot of errors that could start to happen between these two reports. And that comes back to that simplification of that chart of accounts. But this report, why we need it and why we need it to be accurate is that it shows us what we own. So those are assets, shows us what we owe. Those are our liabilities and what belongs to the owner. So that's our equity, right? Our investments as well as our pay that we've received. It shows the overall financial health of our business, though. And from a lending standpoint, you are definitely going to be asked for this because it helps them understand risk. There are a ton of ratios that lenders will run off this report. And so having it accurate is key. It all is values, right? So assets have values, liabilities have values, equity has values. So those account balances can be verified or backed up typically by some kind of statement or some kind of report. So the ability to make it accurate is there. It's just whether or not it is. What you're reviewing, this report doesn't change that often. So on a day-to-day basis, your profit and loss may change, right? Every time you spend money, earn money, and if it's being automated or recorded, then the profit and loss is going to be changing all the time. The balance sheet, really the only time it's going to be making changes. Yes, the checking account balance might change every day because of that money coming in and out. If you made a loan payment, then that loan payment is going to change on the balance sheet. But you can see that overall, with all the different categories on here, it's not going to be changing that rapidly. So this one doesn't usually get reviewed quite as often, which is also why I think it might go sideways a lot faster than some of the other. But you're looking to see that those cash balances look right. Your loan and credit balances are also accurate, as well as your owner contributions and draws are reasonable. So this report helps you answer, where does my business stand right now? So we want to know the overall value of all of our assets, right? And the overall value of all of our liabilities, because that helps us know, can we even get a loan, right? Or should we even be getting a loan? Because if we don't have the assets to cover the liabilities, right, then sometimes that could be highly questionable and that can consider risk. Now, equity, if we're making the investment and things like that, equity is obviously a big deal when it comes to lending, depending on the type of lending program that you're seeking as well. So quick check-in with everyone. I've just dumped a ton of information on you very quickly. But how many of you, or have you as a business, again, you can drop this in the questions, have you been profitable on paper as part of your business, but you were short on cash? So this is just a simple yes, no, not sure question if you just want to throw that in there. I can tell you from my standpoint, this is very, very common, and the majority of people will answer yes to this. So, if you're not reviewing your profit and loss very often, what ends up happening is that your profit and loss report will show that you are extremely profitable, right? And so you've got a great profitable business, which means you're paying taxes, and yet you look at your checking account and you have no money, right? And so we got an answer for growing reasons. I would say yes, absolutely. In a growing business, this is often a problem. And so, how do we solve this problem, or how do we overcome this as a business owner? Because profitability does not give us a true visibility to our cash flow, right, from our business, nor does what we have in our bank account, even from that standpoint, right? So our bank account is what today is, our profit and loss is what was in the past. That's already happened. So how do we tell the future? And that's cash flow management. And cash flow management, especially if we are seeking loans or we have loans, even if we are growing a business, once you start to understand cash flow management, so the first step is learn to track your finances, right? So if I can track my finances and I become really confident with that, then I start looking at my financial reports and I understand what they are telling me. This will happen with all of you. We see it all the the time. You can start where you don't understand finance at all. However, if you take these steps, you start to become more and more confident and understand them. So now I'm understanding my reports. The next thing is, where in the world is my money going and how do I get a handle on what's happening in my business? And so, cash flow statement, really the only way that a software system, or even if you're writing it out on paper, is going to actually be able to create this report for you is if you are uh, utilizing it in a way that's showing you what this future cash flow may look like. So that means you've got your loan payments entered in there. The system knows the date in which that loan payment is supposed to come out. Same thing with credit card payments, if those are future coming. Any bills that you receive, even down to the simplest bill that you pay at the same time every month, you may automate it through your bank. So you're automatically paying like your cell phone bill, right? Or your internet bill. It may seem tedious in order to track all of that. However, from a cash flow standpoint, is where it becomes extremely important to know when all of that is due. To not only when you receive the bill, but when is that bill actually due? So cash flow is showing us how cash is moving in and out of our business, where the cash is coming from. So how are we receiving that money? Are we invoicing someone? They're not going to pay us for another 30 days or 45 days. Or do we use a POS system, right? So when we're using a POS system, we might be projecting based on an event, the seasonality. What's our expectation of sales, right? So this is that one's more of a guess, right? Because sales can go up and down, but generally we can have a pretty good idea on it based on the seasonality of our business once we've started to flow with it. We also can know what our potential is, right? Versus, okay, maybe it's a down day versus what we anticipated. But also, where is the cash being used? Is it paying a loan? Is it paying a credit card? Do we have bills that are due at a certain time, right? Are we going and we buying off the supplies or any of those things where we're just running out there and using a credit card or a debit card? And so, why this matters is it explains why cash may feel tight, right? So, if we had the expectation that money was going to be coming in, or we have a whole bunch of bills that are due, although these people are not going to pay their invoices for another, 10 days or whatever, then money is not going to be in our bank account in order to be able to do that. And so, we start just kind of pulling money from credit cards and emergency loans and whatever that may be, and it becomes more of a chaotic situation than we want to be in. But it really, the whole goal within cash flow statement is to help us plan ahead. So I hear often from business owners, I don't want to put every single bill into my QuickBooks. That takes time. Like I just have it all set up and I know what it is. Okay, so if you don't want to do that, at least if you know the amount, right? And the time in which those are going to come out of your bank account, then that's where you're putting it in there. And you might be a little surprised at how things start to look within your cash flow. First, look at it from a month standpoint, then you can break it down by week, right? Because week to week it might change. And as small businesses, often will pay for things every single day, right? We haven't really gotten ourselves into some kind of system. Some businesses will only pay bills on the 15th of the month or the 30th of the month. And the reason that they do that is because they have a system that they're controlling, right, from their financial standpoint, as well as they understand their cash flow at that point. So even if the bill wasn't due on the 15th, maybe it's not due till the 19th, they're probably still going to pay it on the 15th just because that's their 2 days of the month that they're paying bills. And they have visibility to what's going on. And that's really how you start to control that in and out money that's it's happening in your business. So are all the bills or debt draining your cash, right? Yes, they are, right? That's typically what they're doing. And then you want to know over time when you really start to put this process into place is your cash flow improving or is it declining, right? So this is how we can start to really answer those questions of from a sales perspective, am I charging enough? Am I selling enough, right? Are my projected jobs coming up or things like that actually going to be able to cover what I have? Does it make sense for me to get a loan and add that extra bill that I've got on my plate then? Or will that loan be buying me a new piece of equipment that's going to increase my revenue to here or to there? So there's a lot of really important things that you can do from a cash flow standpoint, not just this is what reality is for me coming up, but also, okay, if I add this in and I change this, I can really start to project what my cash flow might look like if I start to make these decisions. So the key to cash flow is timing. It's not just profit, right? Profit can be big, cash can be zero. We know this. So looking at profit's not going to give us that great example. And as I mentioned before, looking at our bank account is also not going to give us this answer because there might be commitments that we have coming up next week that we don't even see in this bank account. I like to tell the story about business that I worked in. My boss liked to spend money based off of the looking at the bank account. He went out and bought a boat. Really expensive boat, but the boat killed cash flow from our standpoint because he was only looking at what the bank account was, and the only reason we had the money that was in there is because we were paying off loans and doing other things. But clearly, this owner had people working in his system because he understood he had no clue how to manage money, and thankfully, we were able to come back out of that. But the little shocks like that can happen. So don't go out and buy a boat if you have money in your account and you haven't looked at your cash flow. So cash flow check, looking ahead, not backwards, right? So I mentioned profit and loss and profitability is looking backwards. Looking at the checking account is only looking at right now in this moment. And then cash flow is helping us look ahead. So money coming out or money coming in is those expected deposits and invoices, sales, money going out are bills, payrolls, subscriptions, debt, and then we set aside for taxes, also very important. Sales tax, income tax. These are not income. So sales tax very regularly gets miscategorized as income, especially if we're using a POS system. So our deposit is already going to have sales tax built into it, right? So if we're using something like Square or Shopify, and it's really important for us to take that transaction and split it apart into the accurate sections. So we probably have income in there. We've also got sales tax in there. And again, that can overinflate our checking account if we're paying sales tax out of it because we think we have that money. And then guess what? We don't. We get to just hold on to that money and then pay it to the state. So make sure that we're properly setting aside those taxes and planning for them within our cash flow. And then what's left? What's left is really what ends up guiding our decisions. So if we're looking at that cash flow for the next 30 days, 60 days, 90 days, whatever we've got it set up as, start with next week if you need to, start small, build up to it, then that lets us know whether or not we can go buy that boat, which we shouldn't have been doing on our business anyways, because that's a personal expense, right? However, we could buy that piece of equipment, or we could then start talk about a loan for equipment or whatever that may be, buy that new building, add that product line, whatever that may look like. So it works because it reduces surprises. This is the whole thing. We have enough stress in our businesses. Really doing the fundamental planning and the actual taking the time to plan this out, it really helps us plan those expenses, and it takes a lot of stress away, even though it takes time. It shows problems early, so we're already going to know we can't pay our bills next week, right? Because that invoices are never going to come in. So rather than panicking about it then, we can put a plan in place this week and make some different decisions so that we can make sure that we pay our bills on time. It also gives us a lot more control. So if you can see 30 days ahead, you can make way better decisions today about the business and where it's going. So are you ready to apply for funding then? What does that mean? Whether you say yes or no to that question, obviously we're here learning how to track our finances, so maybe this is far off for you and not even a thought in your head. However, everything that we talked about today actually helps you prepare for the documents that you are going to need when it comes time for you to apply for funding, if that's in your future. So most small business loan applications do require that you have business tax returns. So, right, we're in business, we need to file our business taxes every single year. Typically, that's going to look like 2 to 3 years of business tax returns. If we are just now starting out and we are in the loan process, right, we have something called a business plan or projections that you might be asked for. So that's going to look a little bit different because you're not going to have business tax returns for 2 or 3 years. However, if you're already in business and you're just now to the point where you're looking to grow or scale, to add in that funding, those business tax returns are going to get requested. profit and loss statement, right? So we need that to be accurate, as well as a balance sheet. You do not want to walk into a loan officer's office asking for a loan and have these be wrong. This happens a lot, is that might be the first moment that you know that they're wrong because they might not have been checked by someone. However, we do have help or a solve for that. Business bank statements. So your business bank statements are just helping paint that story, tell that story about how those the profit and loss as well as the balance sheet were actually created. And then your personal tax returns. So if you are seeking SBA type funding, there is a personal guarantee that is part of that. And so you're often going to get asked for personal tax returns. It's also a credibility thing, as well as a personal financial statement, right? So they want to know who's running this business, who's in charge of this management of this money. Are you fiscally responsible on the personal side? So therefore, that would translate right to you're probably going to be fiscally responsible on the business side. And then financial projections. So the projections are what's going to happen or what's the business going to look like once this loan happens, right? So is it for the purpose of growing or scaling? What's your sales projections going to look like because of it? What are the expense projections going to look like, right? So it really gives the lender an idea of what the business plans to do with that money as well as what it's going to look like. Without these documents, though, lenders cannot properly evaluate your business. So you can kind of see why step one, start tracking your finances. Step two, categorize everything, right? That's part of tracking. Step three, reconcile everything. Start looking at those reports. Step four, and then you can confidently move into the conversation about lending because you've got a pretty good handle on your business at that point. Common reasons that loan applications get denied: those financial records are incomplete or they're disorganized. Revenue cannot be verified. So revenue on your financial report needs to match money coming into your bank statements, right? So those are, or if you have a Shopify report or a Square report or something like that. Personal and business finances are mixed. Credit history. So there we gotta talk about their credit history, other personal or business. No financial projections are available. The purpose of the loan is unclear, and most of these issues can be resolved before applying for financing. I do have to mention a question that Zach just asked in the chat, because Zach, you know I love you. When is the right time to start talking about a boat? I'm really surprised you didn't say when is the right time to start talking about my private jet. Because that's a question I get a lot as well, right? So, when can I budget to buy that jet for my business, and when can I get the loan for that as well? Well, got to start tracking your finances, understanding your reports, start scaling your business, right? And anything is possible. So, funny story about that is that that same exact business where he bought a boat, I did sit in a budgeting session in order for them to buy the airplane. So, fun fact, they were a $1.4 million business when I started working with them. They were selling equipment off the front lawn because they could not pay their tax bill. So, that's the cash flow issues we have. They turned around and sold that business for $55 million less than 10 years later. So, getting a handle on understanding where your business is going and what's happening with your money can actually yield results. So, they now have a very big home with a yacht in Fort Lauderdale, Florida. So, they did very well for themselves. And it is possible, but don't buy the boat. Somebody's going to scream at you if they're managing your cash flow. So, on that note, help is available if you need it. So if you are interested in learning about how to track your finances more and you want some one-on-one support in order to be able to do that, the help is here. If you want to learn about those documents needed in order to seek capital, as well as putting any of those together, reviewing your loan application before you maybe submit it, the help is here. And it's called the USBCI Technical Assistance Program through the governor's office, as I mentioned before. Different things that we can help you with at no cost is to set up and organize your financial tracking, preparing financial statements, developing those financial projections, building business plans, and so much more. The QR code that's here, you can scan it. It's going to take you directly to the website that's listed at the bottom where it says register at utssbci.com. UTSSBCI.com is going to tell you more about the program. This is a website from SBC Consulting, by the way. It's going to tell you more about the program, and there's a simple button that you click to register there. As I mentioned, any of you that registered for this workshop through the Facebook ad that SBC was running, you're already registered if you said you wanted to be, and our team will be reaching out to you. If you are part of the Moab Chamber and you want that extra level of help, or you're interested in learning more about the USBCI program, you can register. It's real simple. You just put your first and last name, your business name, tell us a little bit about your business, and then we reach out and call you. So this is my last slide for the day. So if you guys have questions or you want to tell me a funny story about your business, thanks, Zach, you can drop that into the question and answer as well. We've got about 7 more minutes in order to do that. I also should be able to unmute people if I can figure that out. I apologize. Zoom webinars is a little bit new to me, and we can do that as well. So we do have a question that says, how do financial institutions evaluate loan eligibility for a company that generates positive operating profits but reports low or negative income due to acquisition financing, debt servicing, and non-cash deductions? What metrics or adjustments should be highlighted to accurately reflect the company's true financial health? Okay, so to answer that, I would say that's probably a very lender specific question, right? And so we would obviously connect you with the lender for the how do they determine loan eligibility, right? Because we're not helping you determine loan eligibility. We're helping you create the documents in which can tell that story. But I can answer that second part, right? So we're going to lean heavily on a business plan and those projections in order to be able to tell that story. So where your financial reports may not be able to accurately tell that, that business plan or those projections are going to be helped to help to be able to tell that. So hopefully I answered that for you. The question that was just here, it just disappeared. So I'm not really sure what happened to it. So go ahead and drop your questions in there.
I answered it. They were just
You answered
asking
it.
about the
Okay.
presentation being sent out. So
Yes,
I'm answering
yes.
as I go. I said we will be sending that out to everybody in the coming week or so.
Yeah, so you guys are going to get a email. It's going to come directly from Eventbrite because you registered through Eventbrite. That will be the recording of this, and I believe I can attach the slides to that as well. And so you will be receiving the link. We actually posted on YouTube, so the YouTube channel has all the other webinars that we've done as well. So feel free to jump in and watch some of those. Some of them are specific to Utah. They may be for the U.S. Virgin Islands. They might be in New York. You never know. It depends on wherever we have one of these workshops. So, but yes, you will be receiving that. Any other questions? Cora's jumping back in if Cora wants to say something.
Yes, I did want to let folks know if you're joining and you're from the Moab area or planning a trip to Moab, we do have a chamber networking event occurring at 98 Center on Tuesday, May 12th. So 98 Center, Tuesday, May 12th at 5:30 p.m. It's going to be great. If you haven't eaten there, it's so delicious. Highly recommend. And we'd love to see you there. You can RSVP on our website, moabchamber.com. Under the events tab, you'll see that event listed. Thanks so much for joining today.
Yeah, thank you. And I do happen to love the Moab area, Cora. As you know, I can't wait for my next visit. I unfortunately was in Utah, was it a week and a half ago, and I was only in the northern part of the state, couldn't make it to Moab. So my next trip out to Utah, I will be in that area. So hopefully I can time it up with one of your events and say hi to everybody.
We'd love to have you.
Yes, thank you. Thank you.
Thank you.
So somebody did ask what the YouTube channel was. I think Karen said it's at SBC First is our YouTube channel. So feel free to jump on there. And once this one is done, there may be a little editing because we were having issues there at the beginning. It'll be listed there. Oh, I love it. So the Gonzo Inn has invited me to stay. I will check you out. I told Cora the very first time we met that I have made many trips to Utah in my days. I am a trail runner. I often am out in the wilderness running on mountains and various other things. And so that's actually what brought me to Utah the first several times that I was there, whether I was running in the Wasatch Range or Zion in particular. So do love the area and we'll definitely be back. And I thank you for the invite to stay at the Gonzo Inn. Sounds fabulous. You are welcome, Terry and Liza. Thank you. Thank you. Any other questions before we jump off of here? Is everybody ready to start tracking their business financials? Is everybody registered for the USBCI program? Yes, no, maybe. If you need help, this program is actually running for 3 years. So this isn't a one and done. I'm talking to you today. So even if your business isn't ready for financing today, as part of USBCI, definitely we can help you get there. And maybe sometime within the next 3 years, that might be something that you're seeking. It does not require that you are seeking capital, though, in order for us to help you. I want to be clear about that. So even if you're not ready, we will help you at least get on track so that you might be better set up in order to get to that part. You are welcome. We love small business. We are all small business owners ourselves for the most part on our team. And so we probably have lived it. I have tons of stories, sadly enough, in my career about owners buying boats and also their business success and all the random little things that happen in small business. Either I've built them myself, I've been in it, left them, exited them, whatever you want to call it. We probably have made more mistakes as well as learned more stories than you guys could ever imagine, but we do talk about it with everyone. So you're welcome. It looks like we have no more questions. So we are going to go ahead and jump off of here, but thank you all for being great participants. We really appreciate it. And I wish you the best success with all of your businesses. Bye-bye.